Hello and welcome to Nirmal Bang. I am Piyush Jain, and today we have decided to bring the focus on the global markets, how and what is happening right now from the perspective of dollar, the interest rates in the US economy at the start of 2023, how are global investors looking for emerging markets? Are they looking to actually bring back the funds into a much bigger way into emerging markets? Given the way we have seen recently a decline in dollar, is it looking much better for India as we move forward into this year? Uh, Budget sectors, what are really investors that you're looking into the Indian markets? Let's try and decode all of that. And for that, let me today now welcome our guest, Mr. Manish Singh, CIO of Crossbridge Capital. So, Manish, welcome to the show. And
Thank you very much.
and you hold very strong views about what's happening in the US economy. So let's first start with that. As you know, that is a barometer also for financial flows across the world. So according to you, right now, from the perspective of dollar and the Fed interest rates, where are we right now? Are we going into some sort of slowdown, or that has been already priced in? What do you expect, and what are you making out at present of US economy?
Mhm. So let's look at what's going to happen next week. So we have the Fed meeting next week, and the expectations are now being managed that the rate hike will continue, though the size of that is going to reduce. So we had a report last night, and as you know, the Chairman Powell speaks for himself at his conference, but there are several other people who tend to speak for him, and one of them is the Wall Street Journal reporter Nick Timiraos. And he published a piece last night where they said that they're going to reduce the size of increase. So you can take it for certain that's going to happen. Now, that means 25 basis point increase next Wednesday. In my opinion, where the economy, Fed should really stop any more increase because I think the damage is being done and the rates are just too high. And the longer it stays high, the more the problem are going to show up in the second half of the year. So for me, the base rate at 450, where it is currently, is already high. Now, having said that, central banking is all about narrative building. Uh, a key job of a central banker is to manage inflation expectation. And for that, they will never stop sounding hawkish, given the mistakes that have been made in the past. So Chairman Powell will increase rates on Wednesday, which in my opinion is the wrong thing to do, but he will increase rates. So you can take it for granted that rates are going to go higher. If you look at inflation, not because inflation is high, and this is why I always say that look at the data, not at the narrative. So if you see the last 6 months of data of US CPI, and if you annualize last 6 months data, and I think it's reasonable that if you have 6 months of data, you can analyze the inflation. People tend to analyze using 1 month, 2 months of data, but 6 months is a really long time to use that. So if you use last 6 months of data, monthly data, and annualize the inflation, that is currently at 1.8% per annum. So it's below the Fed's target of 2%. Now, of course, if you go 6 months prior to that, then of course the headline keeps you at 6.5. So the inflation is not at 6.5, even though the headline is telling you the inflation has come down rapidly, it is coming down fast, and it is below 2%, which is Fed's expectation, as you will see when you go through next 6 months with these numbers. So if you're sitting at central bank and if your claim is that, oh, we have to bring inflation below 2% target, then you are there already. But as I said, Fed will take all its time, given that the market expects Fed to increase rates. They will use their opportunity to get the rates as high as they can. And then if there is any negative reaction in the economy, and you're seeing that if you look at the US mortgage application or approval, it has fallen through completely because you're not going to take a new mortgage out when the rates are high if you think the rates are going to be lower in 12 or 24 months time. So there is several indicators. You look at capital goods, the capital goods numbers are negative, the PMI numbers are below 50. So there is a huge amount of data which tells you that slowdown is setting in. But again, we live in a world where cycles are shorter, the policy response are quicker. So when you had fiscal response to COVID-19 in 2020, which prepared the ground for inflation that we experienced over the last 12 months, you know that if a recession sets in, you will have a rapid response both from monetary side and fiscal side if need be. So I'm of the opinion that my base case at this time, and forecasting is a difficult game, as you know, but I expect, in my opinion, US goes into recession in second half of the year, and that will get the Fed rate cutting. And I expect that by the end of the year, they would have cut rate by at least 150 basis point, i.e., 1.5%. In my opinion, the US base rate should set somewhere at 3%. Anything higher than that will add on to pile onto the pressure, or the expenses, because debt is very high on the sovereign side and other sides. So you can't sustain a very high rate. Or you can high rate for some time to counter inflation, but you cannot keep it there for a long time. By the same token, even if inflation is coming down, and inflation, in my opinion, is at 1.8%, that in itself is not a good news, because what it tells you is the rate of price increase is coming down. But the price increase that we have seen over the last 12 months is still there. If your loaf of bread went from $2 to $3, just because inflation is coming down, it doesn't go back to $2. You're still at $3. So the consumer is being hit anyway. And that is my base case, is why I think that you will have a recession in the second half of the year.
I, I wanted to jump in between and wanted to ask you a question, continuing on this interesting sort of view which you're telling us, from the perspective that perhaps second half sometime we'll start seeing reversal of the interest rate increase to decrease. The dollar has started declining over the last few weeks, and we have seen dollar index has come off from the peak materially. We have also seen that positive effect in Indian rupee also versus dollar. We have seen euro rebounding by more than 10% versus dollar. We have seen also a rally in the gold prices. What is that all telling you? Especially, I'm seeing the 10-year bond and the short-term bond in the US, and that is also telling me a very different sort of inversion scenario. And if I combine all of this, is the market already pricing in very soon that the interest rate rise is now going to get stopped? If not January, maybe March. Like, what is the market pricing in? And especially for our viewers, how should we basically relate that to the equity markets?
So if you look at the dollar, two things to bear in mind. The US inflation peaked in June last year. There was 9.1% print that they had on annualized basis. The US dollar peaked in October last year. So the US dollar weakness is already coming through. And therefore, despite Fed sounding hawkish for last 2 months, the market doesn't buy that, because market has done its forward calculation and thinks that the rate is high, and that is not going to translate into good growth going forward. And therefore, the Fed will have to stop, or Fed will have to cut. Now, first stage obviously is going to be stop or pause, and then the cutting phase comes in. Market, if you're looking at 2-year, 3-year, 5-year rate, and as you pointed out, the 10-year rate, that's based on expectation that what the GDP growth and what the forward-looking inflation is going to be. So the 10-year rate is at 3.5% now. Now, if you look at the last 6 months, as I said, the US CPI is at 1.8%. That's a fair estimate. If you think that the inflation, long-term inflation or medium-term, is going to be sub 2%, you add a premium of, let's say, 1.5% on that, and you're at 3.5%. That's a safe assumption to see where the 10-year is pricing it at this time. So the market has already discounted that. Market continues to discount, and that has helped both the emerging market, the euro, the sterling, and every other currency other than the dollar, and that is being played out. So in my opinion, half of that is priced already, because it's been going on for the last 2 months, and therefore you have seen rally in emerging market assets, rally in Europe. If you look at the European equity index, it's up around 26 or 27% over the last 3 or 4 months. Two reasons for that. That Europe was oversold, so you're coming from an oversold position. And second, you have had a relief in terms of people are moving assets away from one market to the other, because you always have reallocation. And if there's anything that is true in life apart from taxes, it's mean reversion. So mean reversion always happens, when you over. So it works both ways. If you overbuy, you're going to sell it down. If you oversell, you're going to buy. And the biggest mean reversion that you have seen recently is in the Chinese equity. You saw Chinese equities were sold to almost penny level in many cases, large cap stock. It doesn't mean that suddenly 18 trillion economy is not going to exist. But this is what happens when you have wild moves in the market, and those have pricing. With respect to same happened with respect to, I mean, India is a different case because India has internal strength which is building up, so it is not dependent on just the foreign flow. The fact that we have political stability, we have a direction for long term now, and the fact that the international investment community or capital market community looks at India in a very, very positive way, that helps a lot of things that is happening around. Several investments that have been made in the past and changes that have been made in the past on infrastructure level, it takes time. When government starts spending money on infrastructure, the fruits don't bear immediately because it takes time to build that up. We have seen both of that happening in India from the public side and the private side. And you're seeing the fruit of that being born now, and it'll continue to bear. And it hasn't stopped because the investment is still happening on all lenders, and you are in Mumbai and you will know this better than me, that continues to happen. So that will continue to help. So India is a special case in that sense, special case in a good sense, and rest of the market are struggling with growth story. But the strength of dollar has already peaked, and this happened in October last year. A lot of it has been priced, and maybe we have some more pricing to go. But I would not say that the repricing will happen to a large extent going forward. In my opinion,
Right.
more than half has already happened.
So Manish, if I come back to the point, um, either from your fund angle or from the foreign investors angle with whom you would be interacting, from overall angle, if we are talking about dollar not strengthening, and we have seen for a couple of months last year there was actually some foreign outflows, but
Mhm.
then we again started seeing back inflows. From your point of view on India, we'll talk about the budgets and sectors later, but from a timing point of view, in January or first half sometime, is it now a time where the foreign investors will now actually see that, okay, the currency risk is not going to happen now, dollar is not strengthening, India is still looking good? Should we be expecting that the flows in the money will continue to increase?
I would say yes, because largely when the dollar strength story happened last year, you have seen that there was a huge amount of move into US asset. Now, having said that, if you look at the whole last year performance, and let's say we were in Jan 2022, and if I had told anyone is that we are going to have a war in Europe, we are going to have the strongest dollar almost in last many many years, and we'll have inflation at 9 or 10%, what asset would you buy? A lot of people will say, we are not going to touch emerging market, we are not going to touch India. But look how well Indian equity has done, right? Compared to S&P. S&P was down over what, around 20%. Indian market was probably positive, marginally positive. That's a huge amount of outperformance. By the same token, if somebody has said inflation is going to be at 9%, we'll have war on European land, we'll have energy shortage and everything, people would have rushed and bought gold in Jan last year. If you bought gold in Jan last year, it didn't do very well last year. That just points out to you the perils of forecasting and putting too much faith in certain things or discounting things too far. My view and my advice always to investors is that do not fall into the trap of short termism. Short termism is a dangerous thing. You should look at the inherent strength in the economy. That comes from consumer strength, political stability, GDP growth expectation, everything that goes around, things that are structural in nature. And unless you have something which is going to destroy it or bring it down, you have to go along those assets. And that was the main reason. If you wanted to pick out one year where Indian market, uh, freed itself from foreign flow, I will point out last year where the U.S. market did negatively, and Indian market did very well. So it is not just relying on foreign flow coming in; it is relying on inherent growth of the Indian economy, which is pushing more people from saving instruments to capital instruments, because that's when you make your returns. I mean, if you really want to make wealth, where do you go? You go in equity participation. You don't go in deposit. What? Of course, deposit is a safe way of making returns. But if somebody told you that you are in Houston in 1950s, 60s, you will buy energy stocks, right? Because you don't have to be clever. I mean, you just have to be there and buy it. By the same token, if you could be the most cleverest person in 1920 Russia and never make anything. You might be the most clever person, but you'll make nothing because nothing was going for you. And you could be the most dumbest person and sitting in Houston in 1950s and 60s, and you will come out, if you had some money, multi-millionaire, and people will say, oh, look, this guy was clever. It's not about being individually clever or not.
Right.
It's about really knowing what circumstances you are in and where you should be putting your assets.
Absolutely. So I think what actually so far we have talked about is perhaps is looking better from a fund flow perspective. Dollar perhaps the strength is over. We are also talking about perhaps interest rates getting cut in the U.S. market sometime this year. This is all looking good again from an Indian perspective. Our viewers should actually take all of this positively. Now let's go to India. From a budget perspective or from a policy perspective, overall 2023, what are your key expectations and what are you really looking from the government, either from the budget or from the government policies,
So I
from
have to say,
an institutional investor perspective?
sure. So I haven't read recent comments from the finance minister, but I think for me, it has to be a continuation in the sense that the government has to keep raising investments. Government has to keep raising investments. The private sector is doing a good job, and as you see, some of the big corporates, how much equity they are raising to reinvest in India. Those are massively, massively positive, because India is at a very, very sweet spot, right? Because we have not just the positive view that the global market has on India, we also have a very sweet spot of political stability where we know exactly what the policies are going to be, where we know that the government is bent on increasing GDP growth, GDP per capita, and everything. So you suddenly, and also remember, it's not 10, 20 years ago where you had problem with the judiciary or what the policies are going to be. There's a huge amount of resolution on that, and you have seen the bankruptcy code being resolved and everything. So the base is there. Now it's all about how much investments you can put and what it delivers you by way of growth. So that India should not shy away from, because on the bond yields are going to come down, because if you become an attractive market, people are willing to lend you, your yields are going to come down, and that should help how everything else reprice. So my view will be that India should continue to do huge amount of investment, led by the public sector or led by the government institution, because that gives not just a positive view, but that gives huge amount of confidence to private sector that they should be investing, because they will be able to sell their goods that they produce, because GDP growth will be good. So that part has to be led. That part has to be led from the government side in good size. And even if that means that we are running a higher deficit, so be it, because these deficits being run are for the right reason. India has huge investments to make, as you will know yourself. So India should not shy away from that and do more of that, and be really very vocal about it. That these investments are for long-term gains that we are looking to derive.
Where Indian government should be making investments, and I'm trying to link this to the sectors you might be liking. Where you are betting on the sectors and where actually you really want the money to go.
See, I mean, infrastructure is a very generic term, because that encompasses both roads and internet and everything, right? Because now recently I have been speaking to some entrepreneurs in India. When I look at, I'll give you a simple example. If you look at SME lending that has been happening, which is being driven by large banks for a long time, we have new players going into it and using technology to do lending. I give you a simple case. If you have a small SME lender in Mumbai, and I'm just speaking one region, if you can get the capital across to the buyer in time at a reasonable cost, they're going to use that to make investment which will produce more goods, right? So if you are going to invest in technology, if you're going to encourage, let's say you come with a fiscal policy which tells you that X amount of spend on technology or R&D, we are going to give you tax credit, or we are going to help you with that. So what are you doing is that you're not only doing it by yourself, but you are allowing the people who probably are more knowledgeable in where they should be putting their money, you're giving them incentive. So sometimes the spending does not have to be direct, that government has to go and build something up. Sometimes it can be just encouraging the people who have the right skill. Yes, if you are going to do this, which I believe is going to add to infrastructure in double quotes, because it can be anything these days. Infrastructure is not just road, it can be anything. which
Well,
enhances the business. Yeah.
within this, Manish, what are you liking right now? Is there any sectors in particular within the roads? Are you liking roads per se, or you're liking like the companies which are building fibers or data centers,
I
even
would
in
say all.
infra?
I would say all of that. So if you look at heavy technology companies, who obviously will have a role to play. And I don't do single stocks, so I don't have much stocks. But let's say if I look at LNT or anything else, which is a huge player in this, or you have the oil companies which are big player in this. You need these companies all need to keep investing because the capacity building has to happen, and that lead to growth. Most of the time, this GDP growth is not rocket science. It's just very simple that if there are people in India who are looking to do business, nothing should stop them from. And if something is stopping them, I by way of higher capital cost, or they don't have capacity to, let's say, enough capacity to deliver goods to a buyer in a different part of India, that needs to be solved. It just comes from the very simple thing. So any company that helps that, whether it be industrial company which is going to build the road, or a delivery company which is going to deliver the product, or a data company which is going to come up with a better system of managing delivery of different items, all these companies need to be helped, and all these companies need to be invested in. So in India, I would say there are very few sectors that you wouldn't go and invest in. I think largely you can invest in most of the sectors. So I like the index base where you go long India as a market rather than just go one or two stocks, which you can do, but then you have to be on the ground. Because the moment you take individual stock risk, you're taking a bankruptcy risk. Whether this company is real or not, accounting is real or not, and whether this company is going to do well. So for that, I do not have team in place. I do not do that. So I don't like to take single stock risk.
Sure,
But for people who are in India, they should be taking single stock risk because clearly your multi returns are going to be much higher than on the index level.
sure. So let me go back this sort of budget discussion here. Uh, from a institutional investor class who actually would be taking position on the index,
Hmm.
and they would be taking the position on the economy. Um, when actually, from the perspective of big numbers, now making large investment promises is one thing. Also, again, doing large debt raising is another sort of part here. Uh, what actually would really worry you from a budget blueprint, and also then from a sort of as we go forward, and what perhaps will be actually sort of amicable to you that you've already sort of told that infrastructure investment is the one which you would like, but what will really worry you?
So I would say at this time, given the stage India is, I would say any government in place, not just the current government, whatever they do is going to help in the sense that India is a growing economy. So, what you should really look for, what is the government of the day taking away, in the sense what they haven't done. So it doesn't worry me because I think that even if you had a different government, you would still have a decent growth because it comes from internal activity that everyone is doing. You have a largely knowledgeable population that wants to develop business, that wants to do things. You have private money coming in from outside, which is improving the corporate culture, which is improving the responsibility. So there's a lot happening internally, which the government of the day gets credit for. What really government of the day has to do is that what else could they do that enhances it? And this is where my earlier point about that government does not have to go and do everything by itself, or the bureaucracy does not have to go and everything by themselves. They need to engage with the private sector, and they need to provide incentives. Incentives are the best means to get growth going, because what incentive just tells you, you don't have to be an expert of a certain field to drive growth. What it tells you that yes, if you drive growth in that, then it is your incentive, and that allows the private sector to grow. So, by way of what would worry me, I mean, worries are very simple. If government is spending too much on subsidies, which doesn't translate into growth, then that's a concern. If you end up doing too much of subsidy of any kind to buy votes, that's a dangerous thing. And thankfully, we are not in India. We're not in that position because of the lead that the government has and less of these concerns. So this is the problem of when you have coalition government where everyone is promising subsidies, which is just wasting money, throwing money down the drain, which doesn't lead to growth. Thankfully, we are past that. So that's a blessing. But still, if you do not take advantage of the situation you have, you're growing at 5%. You can't just pat your back, or we are the fastest growing economy in the world. It doesn't help. You should be growing at 10%. Look at when you had the large growth phases in China. They didn't sit back and said, 6% we are done. Oh, we are the best economy in the world. How fast can we go? Oh, we can do 12, we'll do 12. We can do 15, we'll do 15. But not because they decided that they'll do 15. They put all the incentive structure in place. They incentivized everyone. Everyone worked hard. And the GDP growth was just an outcome. It was not a target. It is not target that you're going to go to 10 or 15 or 20. They said, let's go and see how fast we can go. But if you could sit back and say, oh, 6 is enough, we are doing a great job, we are the fastest growing economy, and pull out charts and data as to, but that is not going to be good. I mean, it might just look very good overall wise, but it's not about winning the ranking table. That is never going to help you. When you're growing economy, you should go at your full pace at the maximum capacity that you can. So I think anything that will be done, and this is where the narrative building from the government side, from each ministers, from each industry helps. You don't limit yourself by your own target. You said we will see where we go, but are we doing everything to incentivize people? Are we doing everything to provide them? And that part is extremely, extremely important.
So I now actually I go back from a. It's very clear to us. I think that you're taking a very long-term positive outlook on India, and so far the sort of government narrative has been is something which you are liking. Um, I wanted to ask you from a sort of perspective of a top view. Last year, what was the stance on India? Like, was it a sort of any change stance, any neutral, any cautious stance, or you took a backseat? Let's not invest right now. Let's invest after a couple of months. What was the stance last month? Maybe first half, second half, whatever you want to tell. And has there been any change in 2023 so far?
So I would say that when dollar peaked, increasing weighting of emerging market was one thing that I have done in my portfolios, or I have advised on some of the portfolios that we do. So increased weight of emerging market, increasing weight towards emerging market was one trade that was to be done. But that is going to continue. It's not something that has stopped. It was result of dollar peak, and that weighting has increased. Now, given India's weighting in the index, it doesn't translate into huge amount of percentage increase, right? Because India's weight in the emerging market, in the MSCI emerging market index, is there, but it doesn't mean 100% of money is going to emerging market, because there are other monies in emerging market is going to go. Now, if you look in terms of the positive view that investors have on India, I often get asked, how do you invest in India? Of course, you can do index wise, but a lot of money, in my opinion, is also moving in the private sector basis, i.e., private equity and venture capital. That is going in. There are a lot of people doing due diligence on Indian companies. I think the more we have a corporate culture which is very positive or conducive to the way we invest in the Western world, the more you're going to see growth. There's a huge amount of capital which is still waiting. When I look at a business that comes from India, which is at the VC stage, when I talk to the CEO, I still see that there's a lot of gaps that need to be filled. So I advise them. But I have seen a sea change compared to when I would speak to somebody 4 years ago who was doing a venture funding or venture thing. So, in my opinion, that change is already happening. Anything that the government or anyone else can do to accelerate it will be seen as a positive, because the money is waiting to be invested, but the money is not going to rush in just because you have a 10-year growth story. The money can wait for 2 3 years and then come when the the situation is right or the management is right. But that positive overwhelming view is there, and that in my mind is unlikely to change unless we do some accident in policy making in India, which I don't think we will be. And I say we all the time because I still hold my Indian passport even though I live in this country for 20 years.
Absolutely, yeah. So, perhaps the last question, and I'm just trying to understand from your stance on the emerging markets. Are you overweight on India? Like, was vis-a-vis MSCI Emerging Market Index? Is there something of that stance you are maintaining right now?
Okay, so let me point out that so it depends on the mandate. So we have a mandate which largely looks at investing in developed market. Now, given the classification that India still has emerging market, we can never go overweight because we have mandate, where mandate doesn't allow you. So the key thing to look in this will be people who are managing emerging market mandate to see where they are overweight these things. In my opinion, from asset allocation that I have seen or where the discussions go, I have no doubt that they are overweight India because they are managing an emerging market mandate. So the mandate makes a huge amount of difference. What I do is mostly dollar and global and large cap and developed. So we have very few opportunities to invest in emerging market where you can go overweight. You can do a single stock, but then we will be doing on dollar line and dollar line listed in the US. That limits you from going into. But when you buy an index ETF, then you're fully exposed to what's happening in the market.
Okay, so that's something interesting. And perhaps my last question to you would be, if you want to call out for 2023, the best performing asset class, would that be gold? Would that be crude? Would that be currency? Or would that be equity markets? Or in fact, even bond? Like which one you'd be actually most bullish on?
I would say the equity market. I think equity market, for simple reason, equity market was sold off a lot. The gold, as I said, gold is the ultimate insurance, and by which I mean, if things really go bad, then gold is the only thing which is going to help you. But don't look at gold from the point of view you giving you investment returns. So if something does not happen bad, and therefore your gold has not performed, it's a good thing. It's a bit like you having an insurance, and you are thankful you didn't die because nobody called on your insurance. So just look at gold as an insurance. Don't look at it as an investment product. If you go back and look at what happened in periods of hyperinflation in Europe or anywhere, the governments basically tolerated hyperinflation because corporates were getting rid of the debt. So gold is the ultimate insurance. So gold you should always have allocation to. And even if you perform negatively, you shouldn't be worried about it because that was not the purpose. The gold is for absolutely rainy day when something was to go wrong. So I wouldn't bring that in the mix. But when I look at other thing that's happening, to me equity is the most interesting investment you can do because you have, by the way, it just tells you equity participation into growth. So you have an equity participation, and if you have worked for corporations, and I'm sure you have, and other of the listeners, you know who makes the most amount of money, the ones who are the equity holder. So it's just the definition of how you measure return. So equity participation will always make you money, even though it's going to be volatile. But that to me is the long term success that you can derive from investing.
Well, those are the words of wisdom. Manish, as always, thank you for coming on
My
the show
pleasure.
and giving us all of your views. And that's a summary of our show. Manish is positive, continues to remain positive on the India story. Looks like we have seen the worst of the interest rate hike cycle. We actually are stepping into 2023 at some point of time, where actually we're going to see reversal of the global interest rate hike cycle, and also dollar has already weakened, so it's all looking positive for the equity markets. That's the takeaway we take from the show. With that, it's a wrap on the show. Thank you for watching us. Hope you enjoyed it.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.